Good afternoon, everybody. Good morning for the West Coast. Good afternoon for everybody else. Uneducated Economist here. We're going to be talking about how Donald Trump is the king of credible threats. Now, the credible threat theory is one that I have developed here on this channel along with the viewers who have contributed to the idea of what it is that's taken place with monetary policy. And as we did our research going through monetary policy spoken through the FOMC, through their own speeches, we discovered that they are using their words more than their actions to create the economic outcomes that they are looking for. So in today's video, we're going to be showing evidence of how it is that this idea of tariffs is creating an economic activity within the economy that the Federal Reserve is looking for in order to achieve the outcomes that they need to meet the dual mandate. Okay, so let's start breaking this stuff down. The credible threat theory came from a Ben Bernanke speech where he said that once the monetary policy had hit the lower bound of zero, that the adjustment of interest rates would no longer be an effective tool for stimulating the economy. He said, no problem, we have other tools that we can use. And he described the use of a gold machine, an imaginary gold machine. And if you could imagine that this guy invents a gold machine that can produce as much gold at will with very little cost or energy, the moment that information gets out there to the public, the price of gold would plummet on the market, even before the guy produces a single ounce of gold or even has the machine to do it. The credible threat alone would be enough to adjust the market. Now, that is the heart of the credible threat theory. And what we are witnessing right now is the idea of tariffs no longer being legal. Like, it was questioned whether or not they were legal to begin with, but yet here it hits us again with the idea of the legalities of it. This is coming out of Reuters. It's most Trump tariffs are not legal, U.S. Appeals Court rules. It goes on to say this. It says, a divided U.S. Appeals Court ruled on Friday that most of Donald Trump's tariffs are illegal, undercutting the Republican president's use of the levies as a key international economic policy tool. Goes on to say the court allowed the tariffs to remain in place through October 14th to give the Trump administration a chance to file an appeal with the U.S. Supreme Court. So notice that it's open-ended, like, right? So it's just like these things are illegal, but we're going to allow them to stay in place until October 14th to go ahead and figure out whether or not you want to take it to the Supreme Court and find out whether or not they are truly legal through the Supreme Court's, decision. What I find, I just love that. It's so amusing to me. It's just like, man, talk about like open-ended tariff threat, right? It's just like now we don't even know if it's even legal, but they're going to keep them in place, whether or not they're legal, until we decide later on in the future. Beautiful, beautiful play on the credible threat theory to keep that open-endedness, and they did a beautiful job of it. Okay, so something I found, and now I don't know if I'm sorry, I didn't leave the links down in the description of this video. I will, once it's uploaded, I'll grab the links and I'll put them in there for you. But this, I don't know if this is necessarily AI generated, but I thought what it was saying here was pretty good. So I don't know if this was necessarily written by an actual person, but the narrative behind it, I think, is very much in line with that of the mainstream. So if you're listening to like mainstream media narrative, this is pretty much right in line with what is being spoken there. It says this, and this is what I find interesting too, is because people are finally, it's dawning on them that there was a makeup strategy taking place where they were going through flexible average inflation targeting. Anyway, you all know that anyway. But this is what it has to say. The Federal Reserve, hold on one second, guys. Let me make sure my Wi-Fi, oops. Yeah, okay. I just want to make sure the Wi-Fi is off so it's no glitching. All right, the Federal Reserve August 2025 policy framework revision underscores its shift back to flexible inflation targeting, abandoning the average inflation targeting approach after persistent inflation outpaced expectations. Okay, so now that one was a little bit confusing inside of it for most people, but here on the Uneducated Economist, we know all about this because I've been harping on it for so long, that they were going for moderately above 2% for some time to make up for the fact that they failed to achieve it over the previous 10 years. They have moved back to a 2% target and essentially going back to the way that almost everybody is believing them to be anyway. Okay, Despite this, the Fed faces mounting pressure to cut rates in September of 2025, right? Markets have priced in an 87 to 95% probability of a 25% basis point cut, driven by a softening labor market. Now, this is critical to this because everybody is saying you got to look at the labor market, because the labor market is going to be the key indicator on whether or not the Federal Reserve is going to cut. And this is something that we've heard from other Fed officials out there, that we got to focus in on this labor market to make sure that it doesn't weaken to the point that it gets out of control, or just comes to the point that it starts becoming too painful of an experience for people. So ultimately, keep an eye on the labor market. This is what a lot of people are saying. And then on top of that, Trump's push to stimulate housing and manufacturing. All right. It goes on to say this. However, the Fed's hands are tied by inflation embedded through tariffs. What tariffs? Right? These tariffs might be illegal. They may not even been there. They might have been a whole just belief of what could possibly be, but not actually existing. People's behavior changed in a very profound way, not even knowing if they were legal or not. These things can be removed in an instant, right? Like, soon as they're found out to be illegal, you can't keep them in there, except here we got until October 14th, open-endedness, so to keep the credible threat going. So here it goes. However, the Fed's hands are tied by inflation embedded through tariffs. For instance, construction costs have risen due to steel and lumber tariffs. Absolutely incorrect. Lumber has not moved up. Lumber is exactly the price that it was before the tariffs, last year. Lumber prices have not moved. They are incredibly low. $550 per thousand is a very, very low price for lumber right now. Lumber mills are in curtailment like you wouldn't believe because the prices are so low, right? The lumber prices are not high. This is absolutely, it's lunacy to think that, yet it is very common mainstream media narrative belief, right? It goes on to say, limiting the effectiveness of the rate cuts and lowering mortgages. This creates a paradox. Cuts could boost growth, but risk entrenching inflation, while maintaining rates risk deepening a fragile labor market. Now, here's the key thing. They're worried about the labor market, right? Well, what about these tariffs? If the tariffs aren't even legal, wouldn't that mean that the credible threat of these tariffs that has now caused these markets to have this sort of reaction would just be eventually just eliminated if they were just to vanish one day? Here, let's look at it like this. Let's go over to the speech given by Waller the other day, all right? Because it had this to say. What my business contacts are telling me, which is that they are postponing investment and hiring because of uncertainty about how tariffs will affect their input cost and demand for their products. They are postponing investment and hiring. Like, they want to do it, but they're like, I don't know, these tariffs have got me really concerned. I don't know. I can't do it right now. I want to, but I can't. Tariffs. Well, what if there was no tariffs? What if the tariffs just vanished, just went away? Well, all of a sudden, here's a supply of investment wanting to go into hiring, but is being delayed because of the uncertainty around tariffs. Okay? So now, those are the pieces. Do you see it? Here, let me read a little bit more from that because it's actually pretty good. It goes here. That said, I am starting to hear some rumblings that businesses can't sit on the sidelines forever, meaning they're itchy. They're wanting to go, man. I was just like, man, I got the money, I got the want. The tariffs are driving me nuts. Don't want to do it because of tariffs, and I'm sitting here very anxious, trying to deploy some money into hiring. However, the credible threat of tariffs is holding them back. The tariffs are illegal, or maybe we won't know. Got to keep them in place till October 14th, right? Keep the open-ended credible threat going. Goes on to say, so we could see at least investment projects that were postponed begin to pick up, which would be a positive for the economy. Well, do you need to lower interest rates to do that, or do you need to remove the tariffs, right? That are illegal, apparently. Maybe, don't know. October 14th. See how this works? But how employment decisions evolve is more up in the air. Well, no kidding. No kidding, it's up in the air because nobody knows what the heck is going to happen from now until October 14th and whether or not we're going to actually have these tariffs, because they may not be illegal at all. Or it may not be legal at all. They may be illegal to begin with. You know what I'm trying to say. All right. So you guys see the pieces there? So here they have this credible threat of tariffs. The tariffs within itself creates the uncertainty and doubt, right? The uncertainty and doubt is now creating investment fatigue, right? Investment delaying fatigue, right? The longer this goes on, the more that they build up to want to hire. They want to participate. They want to get involved, but they're also very concerned about what it is that tariffs is going to do. So if these tariffs are essentially removed, then there is a buildup of postponement that has been taking place that would go into hiring. This would ease the labor market, right? This problem with a labor market that is getting weak, this would actually support the labor market. Right? Because he's saying right there is a buildup of it. There is a postponement of investment in hiring because of the uncertainty about how tariffs will affect their input cost and demand for their products. That's directly from Chris Waller. So you can see it right there. So like when I think about it, it was just like, man, these guys don't really have to do anything at all. Like they're probably going to do the 25 basis point cut because that's establishing the credible threat, right? To be able to say, oh yeah, we will do it, right? Because if they can do that, they don't have to do it much, right? Because if they can do that, then the people's behavior and their expectations will be that much more enhanced. But really, this comes down to whether or not the tariffs are going to be there here in October 14th or further out into the future, depending on whether or not they need the power from the economy in that direction. Do they need to stimulate the labor market? We'll just ease back on the tariffs. These investments are ready to go. They're ready to go into hiring. So if you alleviate the tariff problem, the uncertainty behind it, you will find that people will start pouring their money into the labor. All right. So that was 12 minutes into this live stream. We're going to keep it fairly short here and go through some of this. I got to go and answer some of these questions. Let me back it up here a little bit. All right, we got hey, grabbing a cup of coffee for this one, right on. Hey everyone, all-nighter. Hey Guntner, smoke that thumbs up like Cheech and Chong. Hello, all-nighter hider and all, calling 10 on the dice. Hey Justin, afternoon all, afternoon deja. Illegal means it violates policy. Unlawful means it violates law. All right, is that true? Thought illegal meant against the law too. No, de facto, it's all the same. De jure, illegal and unlawful are legally different. All right. You're the best, Simon. Thank you. I just got notice that the latex we use in mattresses just went up 12% starting September 3rd. Latex from Indonesia. Like Simon said before, at a certain point, they just have to go forward. I see Fuzzy dies. Kalshi odds for Fed cutting rates more than 25 basis points December 31st. Well, I mean, okay, so here again, so when I started doing some more research into R-star is the difference between the neutral interest rate and the current inflation rate. So say, for example, the neutral interest rate is 3%, like we assume today. Inflation is running around 2.5%. Then the R-star should be running around 0.5%, all right? So, excuse me. So the idea that R-star hasn't moved much is also in line with the idea that the neutral interest rate has risen. Now, if you have the neutral interest rate that has risen based on the inflation expectations, then most likely what you are going to have going persistently going into the future is more inflation expectation than the neutral interest rate being elevated. Now, if this is the case and they cut interest rates, they could very well get close to the neutral interest rate or even meet neutral. or neutral could even rise closer to them. Now, if you start eliminating the idea of tariffs, you're going to start moving people into the economy, and they're going to start wanting to take action in it, right? So, I mean, I just think about it for right now. If people are pulling back on their economic activity, which we are seeing here, evidence of what it is, if we were to believe Christopher Waller and his contacts in business, that they are postponing investment. Well, if you alleviate the pressure of tariffs or the uncertainty behind it, then what is going to happen with the economic activity, right? They're going to start pouring into it. Now, this is going to create, right, the inflationary pressures within the economy as people are going to start behaving in that fashion, right? They're going to start moving forward with that. So if that's the case, then the Federal Reserve would be like, hey, we got to wait and see, right? Data dependent, data's coming in, is actually pretty resilient. Don't know what's going on. Well, maybe it's because you leave the uncertainty behind tariffs, and you have pushed in investment into hiring and buildings and manufacturing or whatever it is that's going on out there. That investment opportunity is now out of the postponement and moving into fruition, right? And so again, that's all based on the uncertainty around tariffs, which may not even be legal. And so this is, again, to me, just adds more power to the credible threat theory. If you can see it through that lens, it makes a lot of sense. Okay? All right. Too bad Native Americans didn't have laws in place. Well, I think they kind of had their own natural kind of laws. All right. So there's delayed investment from the top 20%, which will be deployed. I mean, I don't know about necessarily top 20%. It says business. So, I mean, if you think business is top 20%, I don't know if that's necessarily the case, but okay. Which will be deployed, which does that mean for the 80%? More jobs, but the separation remains high, or does it slow down? The separation, the separation is high, and it will only get higher with the addition of new money. Now, regardless if those people are investing into business or not, you can invest into opportunity. People are going out there and wanting to hire, right? And all of a sudden, there's not enough people to hire, or people are just like, you're going to have to pay me more. So then you start paying these people more. That's an inflationary pressure that comes from it. Now, if that payment starts moving back into the economy, then yes, it would start creating inflationary pressure. But just getting higher wages doesn't necessarily create the additional consumption, because these people are so debt saturated and so far behind in the consumption comparatively to everybody else that they would have to increase their wages dramatically in order to make a difference, right? I mean, it's not just increasing your wages a little bit. And really, when you have more labor tightness, when you have like this hiring of people, what they're really going on here is people are switching jobs for better jobs, for higher paying jobs. But if the job you're in is paying more than what you could transfer into, then most likely you're going to stay still, right? You're not going to transfer your job or transfer to a different job. Now, if you could create an economic environment, Federal Reserve wanting businesses to invest, and if they have credible threat of tariffs removed and then they start investing, now you got a bunch of people hiring. Competition starts to show up for this job, right? People are, or I mean, for a person to be in that job, right? So they're looking to hire somebody. Nobody's coming to the table. Prices for that labor start to go up. And so again, like, how far does this actually benefit into the consumer? I just don't see it taking place in that fast of a timeline. Like, people are looking for a fix within a month or two. Like, wage growth in order to bleed into an inflationary scenario, I can't imagine taking any less than 6 months to a year or more, right? I mean, just because you got a job and it pays better for 6 months, it's still like, you're just getting into the new money. It hasn't really benefited you yet. You got to do it for a while. Yeah. Are you sure R star is the difference? The difference between the neutral and the real rates creates accommodation or restriction. Now, I don't think it's necessarily the accommodation or restriction based on the R star. I think the accommodation or restriction is based on the neutral interest rate, right? So if the neutral interest rate is 3%, right, and you have the Fed funds rate at 4.25%, then you have 1.25% to go to meet that neutral interest rate. Now, what R star, from what I'm recognizing out of it, is the difference in, like, okay, so let me see if I can explain this right. So between 2010 to about 2012, 20, right, R star was slowly rising during that time. Now, very interesting enough is that the Fed funds rate was essentially standing still. Okay. Now, if you can elevate the inflation expectation, you will raise that neutral interest rate. And although the neutral interest rate was very low and close to zero, it was above zero. Right? Now, inflation was running consistently below that. As the inflation, or as at least the neutral interest rate that would neither accommodate nor restrict the economy, was starting to rise based on the inflation expectation that came from the credible threats of quantitative easing and all that. What it started to do is it started to create a rise or a spread between the two, which you can witness between 2010 to 2020, right? Now you can think about it like the Federal Reserve was raising rates in 2000 to what? I mean, I can't remember, 2018 or so. You know, they were on that autopilot program. And Donald Trump was out there, there's no inflation, the Fed should be printing money, right? And so right there, you could kind of see that the neutral interest rate was rising at the time. And the Federal Reserve was essentially maintaining that neutral rate with the Fed funds rate, which was either accommodating or restricting the economy. Trump was recognizing it, saying, hey, there's no inflation, the Fed should be printing money, right? So obviously there was no problems that were happening at the time, right? Although you can totally see it happening in the background. And the inflation that was happening at the time was so low, right? And so this was what was creating that wider gap, right? And then after that, we started seeing that the inflation expectation was rising, and the neutral interest rate, which had also risen with the inflation expectation, had the inflationary scenario elevated, which started pulling that neutral interest rate higher. Then you saw the how it was like, I mean, it was obvious, like back when you had inflation running at 9%, that there was no way that you could have a neutral interest rate being at like 3. Like it would be much higher than that in order to neutralize the economy from an inflationary scenario at 9%. So that would throw everything just kind of completely off the charts in order to try and see it within there. So really, what if you look at it, the inflation was coming down to like an average of what, like 5% or something like that, if you were to incorporate it over the course of the years or a short amount of time. That would put like the neutral interest rate much higher than where it is today, in accordance to where it is that inflation was at the time. It's so hard to explain this stuff. So when you see that the inflation was coming down after 2020, right? Or you saw the neutral, what am I trying to say? The R star coming down after 2020. It wasn't like inflation had come down, right? But what had come is the neutral interest rate was coming closer and closer, right, to the inflation rate of it. And this was what was shrinking the R star. So I guess in order to look at it from a distance is that you can look at the neutral interest rate and seeing the inflation rate falling away from that as it was ticking up slowly. That was rising from 2010 to 2020, right? And then with the inflation expectation being incredibly elevated, the neutral interest rate was rising, making it ever closer to the Fed funds rate and closer to the inflationary scenario that was happening, which was then shrinking that gap between the two. And you saw at from 2020 down to current levels, you've seen the neutral interest rate now having that spread difference coming down to it. Did I get it right on the second part? Like, I know it was really confusing leading up to that, but that's kind of how I see it, right? Is that it's really the spread, it's really the distance between the two of them. Is that you can see the neutral interest rate that the economy is sitting at neutral, even though you have interest rates at 3% or whatever. If you had it even at 5% and you had inflation running at 5%, that's essentially going to end up being a neutral, to the economy as your gain is lost to inflation. Uh, anyway, moving on. But neutral isn't accurate accounting, in my humble opinion. It really isn't deja vu. But that's the whole thing about the R star, is that it's really just a guess. It's a guess on where the neutral interest rate is comparatively to inflation, and really the inflation is due to an inflation expectation coming from the future. So not only is the neutral interest rate not something that you're going to be easily observing, but then of course the inflation is due to an inflation expectation, which can shift very dramatically and change the course very quickly, right? So like these two leave R star in a very like obscure view. It's not accurate by any means, or at least I don't think it's accurate by any means, but it is certainly something that the Federal Reserve uses for their guidance. What is that? Hold on. Where was it? Do I have it here? Sorry. I can't find it right offhand. I was just thinking of Williams' speech the other day and what he had said, something about like that, I don't know, it was a big rambling of jumble of words that I didn't make any sense at all. Like, no, it made sense, but it was just a very like it was a very confusing statement. Anyway, moving on. Monaco 64 had a graph this week of the S&P in dollars and its value in gold since 1971. The S&P in gold was a straight line with no slopes, making it look like nothing has happened compared to gold. Well, yeah, I mean, I guess that's like you could probably do that with a lot of charts and stuff like that. And I mean, if you think about like, I mean, I've I've speculated in silver for a very long time, and never really have I ever been in a position, except for maybe in the last 2 years, where it's actually done anything where I can make like a decent return off of it. For the most part, it never really did anything except for kind of just keep pace, except for short amount of times in when I was have it in possession that I could actually make any kind of decent money off of it. So I don't really look at it in that fashion. I don't really look at things comparatively to the way they were to the way they are today. I just kind of look at the position that I can take today. And when I think about, what it is that but precious metals can do for me, I think of it as an insurance policy, because that's really what it is to me. It's an insurance policy that protects me from a third-party claim. Now, do I expect it to do something like really awesome in the future? I mean, well, I don't deny that could happen, but I don't expect it. Like, I just, whether it happens or not, whatever. I'm looking at other things, I mean, I'm investing in things that have an actual return to it, something that has an interest rate to it, something that I know will have a dividend payment or rent or something, because gold just sits there. It doesn't really do anything. And if you're just expecting it to go up in price, that's the greater fool theory. And it doesn't mean that you're a fool. I mean, I buy the precious metal just the same as everybody else, but that's really what they call it in the investment community, is because it doesn't have any kind of return to it, except for the idea that somebody else is going to pay you more for it than what you pay for it. So again, I mean, they're fun graphs to look at, though. The old accuracy versus precision definition sounds like the Fed shoots for the latter. That's what I was thinking. And credit creation adds to the currency supply, while higher velocity doesn't, but comes with the same short-term symptoms. Yeah. Higher velocity increases prices. Higher lending rates would also increase prices. Yeah. Well, Anyway, I just thought I wanted to share that with you. I thought that was pretty interesting stuff to think about as far as like what it is that the credible threat of a tariff and the legalities of the tariffs and what it means to businesses, or at least the idea of hiring people if that tariff was to be alleviated, or the credible threat of tariffs to be alleviated. Would that create a situation in which that the labor market, which may be weakening, could find a reversal to it just simply off of the businesses postponing their investments, waiting to deploy that money into the economy just as soon as they feel good about it? And if you could alleviate that pain, that pressure, or that idea of uncertainty behind the tariffs, would that create an economic environment in which that the labor market would then find the support that it was looking for, and the Federal Reserve not really having to act at all? And so anyway, thought that was a great video to share with you guys. Let's continue the further discussion when the video gets uploaded. I'll go grab these links and I'll put it down in the description for you guys. Uneducated Economist, you let me know.